Experts predict 30% market crash in 2025, valuations at dot-com bubble levels, recession fears looms as economic red flags mount. Is this the calm before the storm? Scary, right? For months, maybe even years, we've been hammered by these terrifying warnings. Pundits have been screaming about a massive 2025 market crash, pointing to sky-high valuations and blinking red economic signs. By all conventional wisdom, the market should be in a nosedive. But it's not. In fact, for many people, it's been rocketing higher. So what on earth is going on? The folks yelling about the crash aren't necessarily wrong about the warning signs. Some of the data is scary, but they're missing the bigger picture. Let's break down the hidden forces, the powerful policies moves, and the weird, almost irrational investor psychology that are keeping stocks afloat against all logic. This isn't just another market update, this is a look under the hood at the strange machine running the market in 2025. By the end, you'll see why the loudest voices might be looking at the wrong things. The first and most powerful reason this market hasn't tanked is the one that's hardest to see. Governments and central banks simply can't afford a collapse. A deep market crash would create their tax revenues, blow up national debt, and risk the stability of the whole financial system. So while they might talk tough on things like inflation, their actions show a deeper fear of market meltdown. This brings us to the main character in this drama, the Federal Reserve. Throughout 2025, the Fed has been walking on a tightrope. On one hand, they're trying to tame inflation that's still sticking around. On the other, they're seeing the economy slow down, especially in the job market. After a rate cut in September, all eyes are on the upcoming meetings. The Fed's own projections, the famous dot plot, suggest we could see 2 more cuts by the end of 2025. Policymakers have signaled that they are prioritizing a weakening labor market over stamping out the last bits of inflation. One Fed official, Stephen Myron, who was appointed by President Trump, has even suggested that Fed should cut rates more aggressively. This creates what investors call the Fed put. It's the unspoken belief that if things get really ugly, the Fed will always step in with rate cuts or other stimulus to stop a total freefall. That belief acts as a huge psychological safety net, encouraging investors to buy every dip and stay in the game even when valuations look crazy. And valuations are crazy. As of October 2025, the Shiller Cape ratio, a long-term valuation measures, is hovering in the high 30s. That's a level that's getting uncomfortably close to the dot-com peak of 44.2, seen right before the bust in 1999. The forward PE ratio for the S&P 500 is also elevated, sitting between 21 and 23. Historically, these levels point to pretty weak or even negative returns over the next decade. So why isn't everyone running for the hills? Because strong corporate earnings are providing a floor, especially from a handful of mega cap tech stocks. For 2025, S&P 500 earnings growth is expected to be nearly 11%. A huge chunk of that is driven by the AI darlings, with the Magnificent 7 expected to post growth of around 18% this year. But it's not the only story. We're also seeing new highs in other sectors like industrials, utilities, which suggests the rally is broader than some bears want to admit. You have this potent mix, a Fed signaling more rate cuts and a market with surprisingly resilient earnings, all happening under President Trump's budget and tariff policies. That's the first half of the story, but to get the full picture, we need to look away from the spreadsheets and into the human mind. We're about to get into the psychology of it all, and this is where it gets weird. If you're getting value out of this breakdown, do me a quick favor and hit that subscribe button. My goal is to give you the context you need to be a smarter investor, and it really helps the channel. So the second major force holding this market up has nothing to do with balance sheets and everything to do with raw, unfiltered human emotion. Markets aren't just driven by numbers, they're driven by the most powerful motivators in finance: fear and greed. And right now, greed is winning. Specifically, we are seeing a textbook case of FOMO, the fear of missing out. As stocks, especially anything like the AI label, keep hitting new records, investors who were on the sidelines are getting nervous. They see their friends getting rich and start to think, I have to go in on this. And that creates a feedback loop. FOMO drives prices higher, which just creates more FOMO. It's a powerful force that can make a market feel like it can never go down. This ties right into another powerful bias, herd behavior. We're social creature wired to follow the crowd. In investing, that means when everyone else is buying, our gut tells us to buy too. It feels safer to be part of the herd than to stand alone, even if the herd is sprinting toward a cliff. At the same time, we're seeing a classic case of overconfidence. According to the AAII sentiment survey, The percentage of investors who are bullish on the market is currently above the historical average. When people make money easily, they start to think they're geniuses. They start to believe they can time the market or that the old rules of valuation don't apply anymore. This leads to more risk-taking and a tendency to ignore warning signs. So where's the fear? Oh, it's still there, but it's showing up in a strange way. A psychological principle called loss aversion shows that we feel the pain of a loss about twice as much as the pleasure of an equal gain. This can make people do irrational things. Some investors who bought at high prices might refuse to sell and take a loss, just hoping things will get back to even. That reduces selling pressure and helps keep prices artificially high. This cocktail of fear, greed, and overconfidence creates a market that's disconnected from a sober analysis. It's a market driven by a story, not just by numbers, and right now that story is all about AI, Fed cuts, and the idea that you're a fool for sitting on the sidelines. So what does this all mean for you? If the market is being floated on government intervention and irrational vibes, what's a smart investor supposed to do? Well, first and foremost, importantly, stop trying to time the crash. Market timing is a fool's game. No one can, and I mean no one can consistently predict the top or bottom. The very forces we've talked about, the Fed put and wild investor sentiment, make timing even more impossible. Sell everything a year ago based on those scary valuation numbers and you would have missed out on major gains. Now, I'm not a financial advisor or anything. Always make your own analysis before doing anything. Instead, focus on what you can actually control. The key is preparation, not prediction. This means knowing your own time horizon and how much risk you can stomach. If you're investing for the next 5 years or more, you can probably afford to ride out the turbulence. History shows that even after the worst crashes, markets eventually recover and hit new highs. It also means diversification. The dot-com crash taught a painful lesson about putting all your eggs in one basket. While AI stocks are the life of the party right now, you need to exposure to other sectors and even other assets like bonds and cash. This is why I'm not selling everything and running for the hills. I'm making sure, however, that my portfolio is somewhat balanced and not concentrated in the top stocks. I'm also holding a healthy amount of cash, not to time the market, but to have the firepower to buy when everyone else is panic selling. That's the real opportunity, using a downturn to buy great companies at a discount. The goal isn't to avoid the crash, it's to build a portfolio that can survive it. So let's bring this all together. The market should be crashing, but it isn't, not because the bears are wrong about the risk, but because they're underestimating the powerful forces pushing back. You have policymakers who are terrified of a collapse, surprisingly strong corporate earnings led by a world-changing technology, and the wild, unpredictable force of human emotion, where the fear of missing out is crushing the fear of losing. This doesn't mean a crash isn't coming. Trees don't grow to the sky, and no market goes up forever. The current situation is a delicate dance between real strength and wild speculation, but understanding these hidden dynamics is the key. Don't be driven by the scary headlines. Be informed, be prepared, and invest for the long run. That's how you win, not by predicting the future, but by building a strategy that can withstand it. Thanks for watching, and I'll see you guys in the next video.